Last year, Amazon made over $35 billion in profit. You know how much federal income tax they paid? Almost nothing. Meanwhile, you're stressing every April over a $2,000 bill. This isn't a glitch in the system. This is the system working exactly as designed. And today, I'm going to show you exactly how they do it, step by step. When people hear 21% corporate tax rate, they assume big companies are paying 21 cents on every dollar of profit. They're not. That 21% is the statutory rate, what's written on paper. The effective rate, what they actually pay, is often single digits, sometimes zero. Sometimes they get money back. Why? Because the tax code isn't one rule, it's thousands of rules. And if you have enough lawyers and lobbyists, you can use those rules like a cheat code. Let me break down the main moves. Move number 1, depreciation. Say Amazon buys a massive warehouse. That costs $1 billion. Under a special rule called accelerated depreciation, they can write off a huge chunk of that cost immediately, even though the warehouse will be used for 30 years. On paper, their profit just shrank. Lower profit, lower taxes. Congress created this incentive to encourage investment. But when you're a trillion-dollar company buying warehouses constantly, every year is a tax write-down year. It never stops. Move 2, the R&D tax credit. Companies can deduct money spent on research and development. That sounds reasonable. We want innovation, right? Except the definition of R&D has expanded so broadly that software companies can classify nearly everything as research. Updating an app, running server tests, even routine engineering. The result? Google, Apple, and Meta save billions every year just by labeling normal operations as R&D. Move 3, and this one's wild, the offshore shell game. A company like Apple sells iPhones worldwide, but a lot of their intellectual property, the patents, the brand, the software, is officially owned by a subsidiary in Ireland, or the Cayman Islands, or Bermuda. So when Apple sells a phone in Germany, it pays a licensing fee to that offshore subsidiary. That fee counts as an expense. It reduces profit in the high-tax country. Then, the money sits in a low-tax jurisdiction, sometimes taxed at 2% or less. This is called profit shifting. It's technically legal, and it's moved hundreds of billions of dollars out of U.S. tax reach. Move 4, stock-based compensation. When companies pay executives in stock options, they can deduct the full market value of those options when they're cashed out, even if the stock shot way up since it was granted. In some years, companies like Amazon have deducted more in stock comp than they reported in profit. You end up with a profitable company that has, on paper, zero taxable income. Now, you might be asking, how did all these loopholes get there in the first place? Lobbying. The corporate lobbying industry spends over $4 billion a year in the US. That's more than enough to fund entire policy teams whose only job is to write favorable language into tax bills. Often language so specific, it only applies to one company. The classic example? A 2004 energy bill contained a provision so targeted that it applied to exactly one company. One! And that company's lobbyists had helped draft it. Every dollar spent on lobbying returns roughly $220 in tax savings. That's a better ROI than almost any investment on Earth. Here's the uncomfortable truth. Most of this is completely legal. There's a difference between tax evasion, hiding money, which is a crime, and tax avoidance, using legal structures to minimize what you owe. Big companies do the second one, aggressively, and the IRS doesn't have the resources to fight back. Since 2010, the IRS budget has been cut significantly. Audits of large corporations have dropped dramatically. The companies know this. They price the risk of an audit into their tax strategies.
Some things have changed. The 2022 Inflation Reduction Act introduced a corporate minimum tax, 15% on companies reporting over $1 billion in profits. That was a real step. The OECD struck a global deal for a 15% minimum tax on multinationals. Over 130 countries signed on. But enforcement is slow. Loopholes get added through other legislation, and until the incentive structure changes, companies will keep doing what the system rewards them for doing. Which is, by the way, exactly what their shareholders want. So who's at fault here? The companies for using the rules? The politicians who wrote them? The lobbyists? The voters who keep electing those politicians? Honestly, all of them. A little. What I do know is this. The system isn't random. Every single loophole has a name, a story, and a donor attached to it. And understanding that is the first step to being mad at the right things.